Bankruptcy is a word that can cause a lot of anxiety. For many, it feels like the end of the road financially. But what really happens to your credit score after bankruptcy? In this video, we'll walk you through the process, step by step, so you know what to expect and how to move forward. Let's start by understanding what bankruptcy means and why people choose this option when debts become overwhelming. Bankruptcy is a legal process designed to help individuals or businesses eliminate or repay their debts under the protection of the bankruptcy court. There are different types, but the most common for individuals are Chapter 7 and Chapter 13. Filing for bankruptcy can offer relief from debt collectors and a fresh start, but it also comes with significant consequences for your credit score. Once you file for bankruptcy, your credit score will likely drop significantly. The exact amount depends on your starting score, but it's not uncommon to see a decrease of 100 to 200 points or more. This drop happens because bankruptcy signals to lenders that you've had trouble managing debt, making you a higher risk for future borrowing. Your credit score is a reflection of your financial reliability. When you file for bankruptcy, it's reported to the major credit bureaus. This negative mark tells future lenders that you were unable to meet your debt obligations, which is why your score takes a hit. The more accounts included in the bankruptcy, the greater the impact. There are two main types of personal bankruptcy, Chapter 7 and Chapter 13. Chapter 7 wipes out most unsecured debts, while Chapter 13 involves a repayment plan over several years. Both types will damage your credit score, but the way they appear on your credit report and how long they stay can differ. Chapter 7 bankruptcy stays on your credit report for up to 10 years from the filing date. Chapter 13 remains for up to 7 years. During this time, lenders will see the bankruptcy when they check your credit, which can make it harder to get approved for new credit or loans. When you file for bankruptcy, the accounts included in the filing will be marked as included in bankruptcy on your credit report. These accounts are typically closed and will show negative payment history, which further impacts your score. The more accounts involved, the more severe the effect. Bankruptcy is considered a public record and is listed as such on your credit report. This public record status is a red flag for lenders and can affect your ability to get credit, rent an apartment, or even secure certain jobs. The presence of a public record is a major factor in your score's decline. In the short term, bankruptcy makes it very difficult to get approved for new credit. If you do qualify, you'll likely face higher interest rates and lower credit limits. Credit card offers may still arrive, but they often come with high fees and strict terms. While bankruptcy's impact is severe, it's not permanent. Over time, you can rebuild your credit by making on-time payments, keeping balances low, and using credit responsibly. Many people see improvement within a few years, especially if they avoid new debt problems. One way to start rebuilding credit after bankruptcy is with a secured credit card. These cards require cash deposit as collateral, making them less risky for lenders. Using a secured card responsibly can help you demonstrate good credit habits and slowly improve your score. Credit builder loans are another tool for recovery. These small loans are designed to help you build a positive payment history. The money is held in a bank account until you've made all the payments, at which point you receive the funds. This process helps show lenders you can manage debt responsibly. After bankruptcy, it's important to monitor your credit reports regularly. Check for errors or accounts that should have been discharged but weren't. Dispute any mistakes you find to ensure your credit history is accurate as you work to rebuild. One of the best ways to recover from bankruptcy is to avoid taking on new debt you can't afford. Focus on living within your means, building an emergency fund, and only using credit when necessary. This discipline will help your score recover faster. Bankruptcy makes it harder to qualify for loans, especially mortgages and auto loans. If you do get approved, expect higher interest rates and stricter terms. Lenders may require a larger down payment or additional documentation to reduce their risk. Landlords often check credit reports before approving rental applications. A bankruptcy can make it more difficult to rent, and you may be asked for a larger security deposit or a cosigner. Being upfront about your situation and showing proof of income can help. Some employers check credit reports as part of the hiring process, especially for jobs involving money or sensitive information. While bankruptcy can be a concern, it's just one part of your overall financial picture. Honesty and a good explanation can go a long way. Rebuilding your credit after bankruptcy isn't instant. It takes patience and consistent effort. By making smart financial choices, you'll gradually see your score improve. Remember, many people have successfully rebuilt their credit after bankruptcy. If you're struggling to manage your finances after bankruptcy, consider working with a credit counselor or financial advisor. These professionals can help you create a budget, set goals, and develop a plan for rebuilding your credit. There are many myths about bankruptcy, such as the idea that you'll never get credit again. The truth is, while bankruptcy is a setback, it's not the end of your financial life. With time and effort, you can recover and even thrive. As you work to rebuild your credit, check your credit score regularly. Many banks and credit card companies offer free access to your score. Tracking your progress helps you stay motivated and spot any issues early. Key to long-term credit health is building good financial habits. Pay bills on time, keep balances low, and avoid unnecessary debt. Over time, these habits will help your score recover and put you on a stronger financial path. After bankruptcy, it's important to use any new credit responsibly. Only borrow what you can afford to repay and avoid maxing out credit cards. Responsible use shows lenders you've learned from past mistakes. Rebuilding your credit after bankruptcy is a marathon, not a sprint. It may take several years to fully recover, but every positive step you take moves you closer to your goals. Stay patient, stay focused, and celebrate your progress along the way. Make sure your credit report accurately reflects your bankruptcy and discharged debts. Sometimes, errors can linger and hurt your score. If you spot mistakes, contact the credit bureaus to have them corrected as soon as possible. Bankruptcy can be a valuable learning experience. Take time to reflect on what led to your financial difficulties and what you can do differently in the future. This self-awareness will help you avoid similar problems down the road. After bankruptcy, set new financial goals for yourself. Whether it's saving for an emergency fund, buying a home, or simply living debt-free, having clear goals will keep you motivated and focused on your recovery journey. It's normal to feel discouraged after bankruptcy, but remember that you're not alone. Many people have faced similar challenges and come out stronger on the other side. Stay positive, seek support if needed, and keep moving forward. Bankruptcy isn't right for everyone. If you're overwhelmed by debt and can't see a way out, talk to a financial professional about your options. They can help you decide if bankruptcy is the best path or if other solutions might work for you. To sum up, bankruptcy has a major impact on your credit score, but it's not the end of your financial journey. With time, effort, and smart choices, you can rebuild your credit and regain financial stability. Remember, recovery is possible and your future is still bright.